Hey everyone, welcome to episode 62 of the Julia LaRoche Show. I am pleased to bring to you this conversation with Jim Rickards, best-selling author of multiple books. Jim is also the author of the financial newsletter Strategic Intelligence. Jim is an investment advisor, lawyer, economist, among other titles. In this episode, we do a deep dive into the collapse of Silicon Valley Bank, exploring some of the potential near-term and long-term consequences. Jim also explains why the intervention that we've seen from the FDIC, the Treasury, and the Federal Reserve is what he calls the biggest bailout in history. Really fascinating conversation there. We also cover much, much more in this episode. I really enjoyed this conversation with Jim, and I think you will too. By the way, if you are new to the channel, welcome. It is so great to have you. Please be sure to hit that like button and the notification bell so you can subscribe and you won't miss any new episodes. And if you're listening to the show, welcome. It is so great to have you. Please be sure to subscribe and rate and review the show. And if you're a returning listener or viewer, thank you so much. Your support means everything to me. I appreciate you coming back week after week. It's been so fun to grow this show as a one-woman show here. I do all of the guest booking, the interview prep, of course, conduct the interviews and distribute the show. So thank you so much for your support. It means a lot to me, and I am so excited to build the show alongside you and bring you some great conversations. And by the way, join me in the comments section. I do read your comments and I enjoy engaging with you all. And I also really enjoy hearing from you all. Again, thank you so much for your support. And I hope you enjoyed this episode with Jim Rickards. Jim Rickards, investment advisor, lawyer, economist, editor of Strategic Intelligence, which for folks who are watching and listening is a great financial newsletter, and the author, the best-selling author, I should note, of multiple books, including, I know, your newest one that we talked about on the show back in December, which is called Sold Out: How Broken Supply Chains, Surging Inflation, and Political Instability Will Sink the Global Economy. Jim, it is so great to welcome you back on the show. Thank you so much for joining me on this incredibly busy day and busy week.
Julia, thank you. It's great to be with you. It's great to be back on the show. Yeah, busy. Maybe it's a little bit of an understatement in terms of what's going on. I always say that when everything's calm and markets are going up, nobody calls me, and then when the wheels come off, the phone doesn't stop ringing. So maybe I'm the go-to guy for disasters. But here we are. We have a real disaster on our hands.
You are a go-to guy, and I'm grateful again to have you on. And we're recording this on Wednesday afternoon, March 15th. Markets just closed. Stocks across the board lower, oil lower, bond yields falling as well. I know gold was up a bit today, but I think let's start a bit with your reaction to the news. Silicon Valley Bank, Signature Bank. There's jitters now surrounding Credit Suisse. I guess I'd love to hear from you. Maybe let's frame it up. What is your big picture reaction? What are some of the near-term consequences or scenarios that you're thinking about? And also possibly some of the longer-term consequences and scenarios that you're starting to ponder. Let's start there.
Sure, Julia. And a big picture, longer term, probably the most important aspect of this. And we can talk a lot about that. The narrower window, kind of very short term, say Silicon Valley Bank. Okay. What did they do? Well, they did every banker since the Middle Ages has made the same mistake. You borrow short, lend long. So they took in deposits, 75, but thinking 125 billion of deposits, broken into, I think, about 75 in the hold maturity and 40 or so in the available for sale category. So, over $100 billion in deposits. Like, what do you do with the money? A lot of it was loaned to their clients, these tech startups, mostly Silicon Valley, but not exclusively. There's a lot in Massachusetts, some internationally, et cetera. But it was kind of like the other way around. Like, I'll make you the loan, but when I make you the loan, I want you to put it in my bank. So the two sides of the balance sheet, the loan is to the tech startup, but then they put the money in the bank. And so the depositor is also the tech startup, not exclusively. And these are not all startups, by the way. Some of these are, Vox and Roku, and some of these are, mature, successful companies. And they had, in some cases, $2, $3, $5 billion in the bank. And so they used to play to their balance sheet. But in addition to making loans, that was only about half the portfolio. The rest of it they put into government securities, U.S. Treasury securities, and not just Treasury securities, but the long end, 30-year bonds, not exclusively, but heavy on 30-year bonds. So you sit there and say, well, I'm paying my depositors 1% and the bonds yielding 2%, and I can leverage it, 30 to 1 or whatever the regulators allow, because the bond is not considered a risky asset. And the thing about a treasury bond, it's not risky in the credit sense, but it's extremely risky in the market sense. And that, so when we say risk, it's a bundle risk. You've got maturity, credit, foreign exchange, settlement risk. There's all kinds of risks. So they were just looking at the default risk, which is close to zero, but the market risk is huge. And the longer the maturity, the more volatile it is. So they got all these bonds, and they're making spreads, and it's leveraged, and the returns on equity are, huge, and they're partying. I mean, they're taking all this money and going on, staff ski vacations and all this stuff. I've seen it all before on Wall Street. This is not a new story. But you say, well, what happens when interest rates go up? Well, bond math 101 is, if rates go up, the value goes down. Rates go down, the value goes up. It's a little counterintuitive, but it's really simple. The value moves inversely to the rates. Well, March 2022, what happens? Jay Powell starts raising interest rates, and he kept going through 8 meetings. They're up to 4 3/4 today. Another meeting coming up in about 10 days. My expectation, my forecast is going to raise another 25 basis points. And let's come back and talk about that, because the Fed's between a rock and a hard place, but I'll talk a little bit more about that. So get it up to 5%. So the whole time rates are going up, what's happening to the bond portfolio at Silicon Valley Bank? It's going down in value. There are huge unrealized losses in the billions of dollars. So why wasn't the bank, kind of out of business, 6 months ago or a year ago? Well, the answer is they parked most of these bonds, not all of them, but 2/3 of them, in something called hold to maturity, or HTM account. And that means, this is, this is all legitimate accounting. That means you don't have to mark to market. You are exempt, or you have an exception to the mark to market rule. So if you paid $100 million for the bonds and it's only worth $80 million because interest rates went up, you carry it on your balance sheet at $100 million. You don't have to mark down to the 80. So you have a 20 billion, in my example, you have a $20 billion unrealized loss, but you don't have to do anything about it because you don't mark to market. And so, and hey, we'll hold them for 30 years and get paid off and mature and we get all our money back. What's the problem? Well, the problem is you're relying on the deposits staying where they are. And by the way, it's come to light that Silicon Valley Bank in their loan agreement said, when we lend you this money, you have to put it in Silicon Valley Bank, and you may not put it in any other bank. I mean, one of the ways, as a depositor, one of the ways you diversify risk is, take the money, put it in 5 banks. A little more paperwork, but if one of these banks goes down, I've still got the other 4. I'm good to go. But the borrowers had to put it all in Silicon Valley Bank, so everybody's locked in to this party now. As soon as the depositors start taking money, and by the way, these deposits started to flee long before, before last Wednesday, when when all this happened. I guess it was the 8th, March the 8th. I think it was Thursday. March the 9th. Sorry, March the 8th. I think was the Wednesday. March the 9th was the Thursday when the stock crashed 60%, and then the whole thing was taken over by the government on the 10th. But the deposits were fleeing long before that. So there was some leakage. Moody's was saying, we're going to downgrade you, but that was not announced publicly. The mark-to-market losses were there, but that was not announced publicly. They brought in Goldman Sachs to try to raise capital. So they had a plan. So as the deposits are fleeing, now they have to sell the bonds to get the cash to pay the depositors. So that whole thing about don't mark to market, hold to maturity, you don't have to mark to market. Well, that's true if you're holding them. But the minute you have to sell it to pay off depositors, you take the hit then and there. There's no more deferral of that hit. So they were having to do that. So Goldman Sachs said, okay, here's the plan. Sell the bonds, sell some extra bonds, sell some additional bonds, reinvest them in higher yielding bonds. That'll satisfy Moody's. You'll still get a downgrade, but it won't be severe. And we'll raise $2.5 billion for you. So they were taking a $1.8 billion hit. And that had to be announced because they're a public company and they're regulated. But Goldman says, we'll go raise $2.5 billion. That'll fill the hole in the balance sheet, make you stable, et cetera. And they got a $500 million circle from General Atlantic. They were going to, it's a very large, prominent the Connecticut-based venture capital private equity fund. They were going to do 500 million, and then Goldman was working. The fund was trying to get the rest. What happened was, as soon as they announced the loss, and Moody's did the downgrade, you should have been ready to close the deal right then, like the next day. It's like, okay, and by the way, here's the 2.5 billion. They didn't. And there's a lot of, there's the market risk we described, but there's just a lot of gross incompetence at Silicon Valley Bank. They had, we're talking about risk management right now. They had a vacancy in the risk management officer. There was like 6 months or more. Nobody was in the position. They weren't thinking about it. And then at least, and there were some good lawyers, and Sullivan and Cromwell, they represent Goldman Sachs. There was some good lawyers involved, but Silicon Valley wasn't even ready to sign NDAs. Like the potential investors were like, okay, we'll take a look, sign this NDA, and give us all your books and records. And by the way, this is hairy, so it's going to take a couple of days. Why wasn't all that done, a week prior or longer? And why wasn't SVP able to get their lawyers to stay up all night and do the non-disclosure agreements? So they bungled it. They lost the opportunity. And then, Peter Thiel says, get all your money out, and other VCs. I'm not blaming Peter Thiel. That was actually a very smart thing to say. But then it was just over before Goldman could get the deal done. Government takes it over on Friday night. Now, here's where it gets really interesting. The government press release from the FDIC said, okay, actually it was the state of California shut them down, appointed the FDIC as receiver. FDIC sends a press release on Friday and says, okay, we're in charge. But the press release, and I read it closely, it was interesting. It said, okay, all deposits of $250,000 or less, you're fully insured, you're getting your money, it'll be there on Monday. Everybody else is wiped out. That your deposit is gone, not just frozen, but gone. They gave them what they call a receivership certificate. So here's like an illiquid IOU. And you say, well, what's that worth? And the answer is, we don't know. We have to sell assets, and then we'll pay off creditors, including yourselves, and you'll get something on your receivership certificate. It's like, yeah, is it 10 cents on the dollar, 90 cents on the dollar? No one knows. I mean, you can guess, but they don't know until they sell the assets. And having gone through this with the Resolution Trust Corporation in the early 90s, that can take 6 months, a year. It actually took, I think RTC did a good job, but that took 2 years from kind of 90 to 92 to clean that up. So you actually don't know. Meanwhile, who's got the receivership certificate? Who used to be a depositor? All these startups we talked about. Well, I don't care if you have 25 employees and 2 million in working capital. You got a payroll. You got to pay the rent, pay the employees, pay the vendors, pay the developers, the coders, et cetera. And they couldn't because their money was gone. So now they were just going to sequentially and very rapidly fail. They were going to, file for bankruptcy or close their doors because they literally couldn't meet payroll. And this is where the White House got involved, because then they're like, all these techies, all these, and then you have tech startups, we talked about that, but who owned the tech startups? Well, this is where you get into the Bill Ackmans and the, Peter Thiels and Larry. You get into all these big players who own all these little startups, Kleiner Perkins, Google, whatever. Well, who are they? They're very heavy Democratic donors. And what were these startups doing? Well, everyone thinks, I must be working on a new app. That's not true. A lot of them were climate-related, sustainable resource startups. They were working on the Green New Deal. And by the way, it's not exactly a viable business model, except if you look at the Inflation Reduction Act that Nancy Pelosi pushed through last August 2022, that was about 800 billion, a little bit more, maybe 900 billion. But that was called the Inflation Reduction Act, which is nonsense. That was the Green New Deal. That was the Green New Deal that AOC wanted from the start, and not all the money, but well over $200 billion was available for rebates, tax refunds, tax credits, et cetera, for people doing work in so-called sustainable resources, and many of them were. Now, we don't have 5 hours to talk about why the Green New Deal is the Green New Scam. That's a separate topic, but there's no doubt that the White House favored it and the Democrats favored it. So not only do you have Democratic donors, but the clients of Silicon Valley Bank were working on projects that are completely favored by elites, Democrats and Republicans. And a lot of their business models were based on getting these tax credits. So all of a sudden, you were not just blowing up a bank and the tech startups, you were blowing up a lot of initiative in the climate change arena, which again, I have a low view of that, but doesn't matter. The White House thinks it's great. So the ripple effects of this went on and on. There were something like 500 Israeli startups that would have been potentially put out of business. There were several hundred UK startups that petitioned the Exchequer, to get a rescue of the UK branch of Silicon Valley Bank, Chancellor of the Exchequer. So this thing was all of a sudden rippling all over the world. There were a lot of elite interests that were threatened, and so Sunday night, and I have to say, I've studied this very closely. I know a lot about banking. Sunday night at 6:15, the Fed, the FDIC, and the U.S. Treasury came out with a press release. They said, "Just kidding. The deposits are good. It's all good. We're going to guarantee unlimited." So now you're talking, oh, it's not 250,000, it's 5 billion in some cases, or $2 billion in other cases. And they said yes. And so it was a 180-degree turn from what the FDIC said on Friday. It was like deposits are dead. It's like Dracula back from the grave. The deposits are alive as of Sunday night. And not only that, but the Fed proceeded to guarantee every deposit and every bank in the entire U.S. banking system. Here we're talking, $6 or $7 trillion of assets. And the way they did it was a lot of other banks, big ones and small ones, at least the big ones had good risk management, but a lot of small and medium-sized banks, they had the same problem Silicon Valley Bank had. Maybe the depositors weren't walking out the door, or maybe they weren't funding tech startups, but they had underwater bonds and overnight deposits and were facing the same thing. So the Fed said, okay, all you banks, if you send us your bonds, we'll give you cash. Okay, that's just a normal discount operation, but that will give you cash equivalent to the par value. So again, remember the market value is like 80 cents on the dollar, but the Fed says we'll give you 100 cents on the dollar. So now you not only get to you ship your bonds to the Fed, they give you not 100%, which is like low collateral, but they give you 120%. So the banks are shipping in bonds that are worth 80 cents on the dollar.
Wouldn't everyone do that then? Like if you're going to get...
Yeah, exactly. That's the point. That's exactly right, Julia. Why wouldn't you do that? I'm like, hey, Fed, if you want to give me a low interest rate bridge loan with 80% down, I'll take all you got. So now the banks are going to do that. And by the way, because it's structured kind of like a repurchase agreement, there's no sale. So they don't have to market to market. If you sold it to a third party, a dealer, you'd have to take the loss, but now they don't have to take the loss. So they're shipping in billions, potentially $1 trillion or more of these bonds. They're not getting 80, 90 cents on the dollar, which is what they're worth. They're getting 100 cents on the dollar, which was the original purchase price. They don't have to take the loss, and they're getting cash. Why wouldn't you do that all day long? So in effect, not only did the FDIC do a 180 between Friday night and Sunday night, but they bailed out the entire banking system to the tune of trillions of dollars. They just blew up the $250,000 limit. Forget that. I mean, I know what the statute says, but they threw that out the window. And the moral hazard, the economic consequences, the repercussions of this are kind of unimaginable. I mean, I can sketch them, I can talk about them, but this is to hear Johnny Hall say it's not a bailout. Are you kidding me? This is the biggest bailout in history. And I negotiated the LTCM bailout. I lived through that. That was $1 trillion of derivatives. But through 2008, 2020, the pandemic, I go back to 1994, the Mexican tequila crisis. I've lived through all these and been more or less directly involved in all of them. And this is orders of magnitude greater in terms of what's being bailed out. And one last thing, and I'll shut up because I know I talk too much, but go back to 2014, Brisbane, Australia, the G20 finance ministers. They had been wrestling with the political fallout and the blowback from the 2008 rescue, because, without reliving the whole 2008 episode, that was basically using taxpayer money to bail out all the banks. They all, Bear Stearns and Lehman went down, but everybody else They got to keep their jobs. They got bonuses in 2008. Their stock price fell, but then it went back up again. There was no accountability. Nobody got nicked. Everybody kept their jobs, kept their bonuses, kept their stock. It all went back up again, and all done with taxpayer money. So the taxpayers are like, wait a second, I lost my job, or my business failed, or my cousin's out of work, whatever. But you took my tax dollars and bailed out Jamie Dimon, John Mack, and the heads of Goldman and Citi and all the rest. So there was enormous political fallout from that. So the G20 was like, well, what do we do about that? There will always be another failure. And of course, they're right. So in Brisbane, they switched. They said, no more bailouts. From now on, we're going to have bail-ins. And what's the difference? Bailout is when you use taxpayer money and you bail out the depositors and the stockholders. A bail-in is when you turn to the bank and say, no, we're going to fill the hole in your balance sheet with depositor money. The depositor is at risk. We'll pay the insurance amount. It's 250,000 US, 100,000 euros in Europe. So we'll pay that, but that's it. And we are not bailing out any depositors or note holders or anybody else. We're going to haircut them until the hole in the balance sheet is filled. And then if there's anything left, yeah, you can have what's left, but everything else is at risk. We're not going to the taxpayers. We're turning to your depositors, and they're going to suffer and they're going to pay the price. And that was the bail-in rule. Well, it turns out, and that was 10 years ago, well, 9 years ago, there were no major bank failures between 2014 and last week. Little ones, but nothing systemic. So they came up with this new bail-in philosophy in 2014, but it had never been tested. It had never been used. This was the first time that a government agency, in this case the FDIC, said, yeah, bail-in is the new law of the land, and we're gonna whack the depositors to make up for the losses. Well, that lasted exactly 48 hours till Sunday night. So here you have a 9-year rule. Oh, we're no more bailouts. Boom, within 48 hours, they flip and they do the biggest bailout in history. So they have no credibility. The FDIC fund is going to be seriously depleted. The idea that the taxpayers don't have to pay is nonsense. Why? Because you're going to deplete, since you took away the $250,000 ceiling on deposits, you're going to deplete the FDIC fund, the insurance fund, to pay off all these claims to, Roku and Vox and all these people. So how are you going to replenish the fund? Well, they're going to increase the insurance premiums on the banks. Okay, well, the banks are going to pay that, but where are they going to get reimbursed? Well, they're going to charge the customers fees, or they're going to pay you less interest. In other words, it comes out of the pockets of everyday Americans, no matter what you do. You can launder through the FDIC and the bank insurance premiums, but at the end of the day, the banks are going to charge the customers, and so you're paying for it at the end of the day. So this, apart from the bailout that I described, this was a complete repudiation of 9 years of fiction that somehow depositors were going to get bail, would pay the cost of a so-called bail-in. No, they're just back to the bailout.
There's a lot in there to explore further. So let me ask you a couple follow-on questions. There was an argument that was out there. It was pervasive on social media that if the government didn't step in and act, that there would be lines at regional banks starting Monday morning, that people would pull out their money and put it into the bigger players. There was also an argument of, if you change the name of Silicon Valley Bank to Farmers Bank of Iowa, maybe people might feel differently. I'd love to hear your thoughts there. And then another question, just for while I'm having this kind of stream of conscience here. Did we nationalize our banking system with this action, or effectively make them utilities, or are we on that path to doing that?
That's a great question, especially the last part. I would say we did. I mean, I know they're privately owned. Well, the Federal Reserve is privately owned, actually. That's another, we'll maybe spend some time on the corruption side of this, but the CEO of Silicon Valley Bank was on the board of directors of the Federal Reserve Bank of San Francisco. Now, Friday night, his name mysteriously disappeared from the website, but he was on the board of directors. So here you have, and by the way, he sold about $3.4 million worth of Silicon Valley stock on February 28th. So why is he selling the stock 10 days before the bank goes under, it gets taken over by the government? Now, I don't have enough facts to say that's insider trading, but it kind of walks and talks like it. Now, he said in his own defense that, well, this was part of a agreed plan. If you're an insider and you worry about insider trading, you can come up with a plan and run it by the SEC and say, okay, I'm going to sell 5% of my holdings every month. Like every month, like clockwork, I'm going to sell 5%. So don't accuse me of insider trading because this is a pre-established plan. He had one, and that sale was according to that. But who's to say that the plan itself wasn't a front for the insider trading? I'll leave that to the courts and the SEC. But personally, I'm not, and I am a lawyer, I'm not persuaded that just because you have a plan, you do have to inquire as to whether the plan itself was part of an insider trading plan, knowing what we just talked about, knowing that the bonds were 20% underwater, knowing that billions of dollars of losses were waiting to come to the surface. You should have known that a year ago. That it didn't hit till last week, but you should have known that a year ago. So file the plan, dump your stock, under legal cover, so to speak. So that's just some of the kind of, in my view, corruption. I won't say criminality, but corruption that was going on. But if you said, what's the bottom line? Oh, sorry, going back to the other part, Julia. Yeah, there would have been lines at banks, probably. I think that's likely. I got, I don't know, old friends, family members are calling me on, DM or email or text or whatever. Hey, Jim, I got 30 grand in the local SNL. Should I pull it out? And I said, no, sit tight. It's fine. But yeah, I think that would have happened. Certainly the failure of a large number of tech startups in Silicon Valley and elsewhere, I think that would have happened. Now, but we don't know. I mean, is it possible that they could have turned to their venture capital backers to say, hey, my money's tied up for maybe a year in this, receivership certificate. And they would have said, okay, well, we like what you're doing and your tech's good. Here's another 2 million to tide you over. We'll make it a bridge loan or charge you a high interest rate. Who's to say that people creatively and adaptively and in their own financial interest wouldn't have found a way to work through this? Well, we'll never know because the government just didn't want to find out, and they took over, and but the biggest crybabies over the weekend were the billionaires. It was Mark Cuban, Bill Ackman, and others. Kevin O'Leary may not be a billionaire, but he's pretty wealthy. These were the guys screaming and crying, "Oh, you got to bail this out!" You didn't hear it from everyday people. They seem to be happy with their own bank. So I question that scenario could have happened, and that's certainly why the government acted. But I question whether there wouldn't have been, some benefit of letting the chips fall where they will. Hey, you like this company? We'll put up some more money because sorry, they got no liquid asset, and that's their blunder. And maybe risk managers around the country would have sat up and said, well, I need to do a better job. There are futures, there are options, there are ways to kind of sell your portfolio on stages and take the loss a little bit at a time. There are ways to manage around that, but everyone was just depending on the Fed because after all, the Fed has bailed out every crisis since 1994 and probably earlier. But the last point, yeah, the banking system, whatever the ownership structure, is de facto nationalized because when you guarantee something, and the Fed has guaranteed all the portfolios and all the deposits, the FDIC has guaranteed all the deposits, and the Fed has guaranteed against portfolio losses because they said they'll take the bonds and give you 100 cents on the dollar. There's always a price to pay. You don't get that kind of bailout without the government coming up with new regulations. The government's ability to say, oh, by the way, we'd like to see you make more loans to climate change. We'd like to see you make more contributions to democratic, political action committees. We'd like to see you, get into this whole, equity diversity thing. You're not doing enough in that area. You've got leverage now because you can always kick one of these banks out of the club, and they are dependent on you. The government is their oxygen supply. So I think it's a very, not just a good question, but a really, smart observation that in effect we've nationalized our banking system. We did.
I did see Bill Ackman come out with like a response, and he said, I don't have any direct exposure to SVB Financial nor does Pershing Square. I am personally an investor in some of the less well-known, mostly seed stage venture and biotech funds and some early stage startups, which may have exposure to SVB. Collectively, my venture exposure is less than 10% of my assets. I do not know about the other folks, but let me ask you this too. Okay, so by them stepping in here, let's say, does this eclipse the bigger crisis, which I'm just thinking out loud here, inflation, which you can maybe make a case that affects more folks. Like, how does this tie into your thoughts on inflation and what the Fed might do in terms of addressing inflation through rate hikes? Does this kind of change how you view? Because I did hear you mention rates at the beginning. I kind of missed it, but I do want to hear your thoughts there and
Sure.
on inflation.
Yep. And just on the Ackman thing, I would bet money that that statement you read, and yeah, I saw that in the press. That's what he said, was written by a lawyer. Because I happen to, for better or worse, I am a lawyer, so I know all the lawyer's tricks. So as soon as I hear the key words and what you read, Julia, the word direct, I don't have any direct investments. Okay, well, what about your indirect investments? So that's the first thing. And he says, yeah, I have some of those. Doesn't say how much. Doesn't say where they are, and then even that is limited to a portfolio of private equity investments. But is he in some of the big VCs? Is he in Centerbridge? Is he in Kleiner Perkins? Is he in other funds, et cetera? I don't know.
Yeah, I don't
But
know either.
right. But that's the point. It was a carefully worded, a lot of wordsmithing going on in this. I don't question the truthfulness of it. I'll say, okay,
Yeah.
that's a true statement. I don't question that. But there's a lot of wiggle room between direct and indirect, and yeah, but not how much, et
Well,
cetera, without, and then list a category, but not say what other categories might be in there. There's just a lot of wiggle room in that.
let me ask you before we get to the inflation part, what do you think should have happened to the depositors? Because it's FDI, it was FDIC insured up to 250,000, but we know like the bulk, like it was like what I want to say 95%. I'm probably wrong, but it was a huge portion had more
No,
than 250,000.
you're
How do
right.
you think about, like, I'm just thinking out loud here, the humanitarian side here, because I've had some conversations with folks. It's been a debate. I people feel very strongly one side or the other about these companies making payroll and whatnot, and maybe like being more realistic about how much you should have in the bank to cover your weekly expenses. Some companies I imagine have very high weekly expenses. How do you think about, should the depositors be made whole? How do you feel about that?
It's, for 8 billion, 3 billion, 2 billion, I don't know. It seems like there's a lot of room for a haircut there. Even these very successful companies, they don't have $2 billion payrolls. It might be, 100, it might be 10 million or something. I don't know. You do the math on that. But the point is they could have taken a substantial haircut. It didn't have to be all or none. It didn't have to be zero or full. Like, how about half? We're gonna cut all the deposits by half and give your receipt and like guarantee the rest. That's still a bailout, but at least again, some of these, there were a lot of startups, and those startups might have failed over the course of the next couple of weeks. I would acknowledge that. They have 20 employees. I'm saying I don't care about 20 people. I do, but I'm saying that's not going to shake the world. And a lot of this money, you're right about the number. I think the number I saw is 97%, but yeah, 95, 97%, overwhelmingly uninsured deposits. Pardon me. And why weren't those deposits spread around among 10 banks? That's just good risk management. Why didn't the corporate treasurers, or how do we know they did or didn't? Why didn't the corporate treasurers buy, you can buy credit default swap insurance on banks. You can buy credit default swap insurance on, any kind of market volatility. Why didn't they have insurance? Why didn't they have swaps? Why didn't they have futures? Why didn't they have options? Why didn't they spread the money around? Why didn't they diversify? This is not rocket science. I mean, I hate to use a cliche, but this is risk management 101. They didn't do any of that. They were completely concentrated in one bank, which itself had no risk management. So, or no competent risk management. So my sympathy is very limited. And by the way, if it's a humanitarian issue, and yeah, that's the way a lot of people are framing it, you're right. What about the homeless? What about the mentally ill? What about 100,000 Americans dying of fentanyl? What are we doing about the border? What are we doing about Chinese and Mexican collaboration in manufacturing fentanyl and making it candy colored so kids will get addicted or kill themselves? And by the way, the Chinese, I spent a lot of time in China, and I do a lot of work there. The Chinese people always say they think in centuries and millennia, and they do. This is their revenge for the Opium Wars. I mean, what happened in the 1840s Well, the UK was running a trade deficit with China because the Chinese didn't want anything that the UK was selling. The English and their colonies and possessions, they wanted silks, they wanted tea, they wanted natural resources, they wanted ceramics, they wanted all kinds of things from China. They were buying them, and China didn't really want anything from the UK. And in those days, it was a mercantilist system where you had to settle up in gold or silver. Chinese had a kind of particular appetite for silver. So there was a huge drain of silver from the UK to China to pay for the net trade deficit that the UK was running. But Whitehall was like, nah, that's not good enough because we want the gold and silver ourselves. So they had a task force and said, what can we sell the Chinese? Well, they'll have to pay for it and they'll balance out the trade. The answer was opium, because the British had northern India and Afghanistan. And so they said, the Chinese will sell you some opium. And they said, you crazy? We don't want that. Even the decadent Qing dynasty was smarter than that. And the British said, too bad. They sent the Royal Navy into Hong Kong and they blasted the port open with cannon fire and took over and forced the Chinese to buy the opium. And then not the entire, but a large segment of the population got addicted. I mean, you've seen people with pipes and opium dens. They look emaciated, and they are. But we got the Chinese, this is the British. The Americans had a hand in it, the Delanos and others, but got the Chinese hooked on opium so they could solve a balance of trade problem. And the Chinese never forgot it, because they went from the Opium Wars to the Boxer Rebellion. There was a Taiping, Heavenly Path Rebellion, took over half of China, and then the unequal treaties, and then the Japanese invasion, and the Civil War, other period, the warlords in the 1920s. So China went through 120 years of chaos and turmoil until finally Mao Zedong took over. But they never forgot about the Opium War. So now they're turning that around on us. They're selling us fentanyl. Hey, let's get the Americans addicted. Let's kill the Americans. And they are. And Mexico's working hand in glove with them. So if you're concerned about Roku having $1 billion or so deposit at Silicon Valley Bank as humanitarian, I would say, okay, there's a long list of humanitarian causes I would put in front of that.
Yeah.
But let's get to the sorry.
No, it's no, and when I use that word, it's because I had a conversation with someone earlier, and they kind of phrased it that way, and it's kind of like perplexing to think about. But yeah,
I'm just guessing. I do watch the show, but I'm guessing that you were talking to a billionaire or someone.
No, it wasn't recorded for the podcast. It was just a phone conversation earlier. But yeah, no, I mean, it's just been incredible to watch, like how divisive it's been as well. Just mind-boggling. But yeah, on the inflation front, I am curious your thoughts there. Okay, does this crisis kind of eclipse that one, or what do you think the Fed does next week? We have the meeting next week.
Yeah. Okay. So I'll give you. I spent a lot of time on the Fed, and a lot of our newsletters are devoted to that. So they're going to raise interest rates 25 basis points until, 10 days ago, there was a debate, 25 or 50, 25 or 50. And Jay Powell left his options open, and the congressional testimony, which is literally just 2 days before Silicon Valley Bank blew up. But so 50 is off the table. They are going to do 25. And then the question is, okay, what about May? What about June? They got, 6 more meetings this year. So here's the Fed's dilemma, and it's playing out in real time. So Jay Powell gave 8 speeches or press conferences between August 26, 2022, which was Jackson Hole, then the September FOMC, November FOMC, end of November he did Brookings, December another FOMC, February another FOMC, and then 2 days of congressional testimony. So I've lost count, 7 or 8 speeches or remarks. And they said the same thing every time. He said, inflation is job one. We're on a path to raise interest rates. We're not going to quit until inflation is under control. Now, there's a little wiggle room around that. Their target is 2. The latest CPI was 6%. Core was a little bit lower. They actually look at personal consumption expenditure year over year. Core, that's their metric. There are 15 ways to measure inflation, but that's the one they like. But even that is still over close to 5. It's a long way from 2. That's the point. You're trying to get to 2. They're a long way from 2. So, but there's something called the terminal rate. What's the terminal rate? Well, no one knows the number. I don't know because Jay Powell doesn't know. So we're all estimating. But the terminal rate is defined. It's a rate that's high enough to bring down inflation on its own without further rate hikes. You got to we can stop here and confident that inflation is going to come down without doing more. Because the conundrum is, okay, they've been raising rates since March 2022. Monetary policy works with a lag. Inflation peaked in July 2022, and it has been coming down ever since. That's, some months were, February was a little hot January was hot compared to December, but the trend has been down. So and they're raising rates and inflation is coming down. So that's good. But here's what they don't know. Pardon me. Was inflation coming down because they were raising rates? Or had they already hit the terminal rate and they just didn't know it? Because Wall Street was like, no, you've hit the terminal rate. Stop, please stop. You got this under control. The Fed doesn't believe that. One of the greatest blunders in monetary policy was Paul Volcker in 1980, who had started raising rates in 1979 and inflation was coming down. But then in 1980, we had a very sharp recession that had nothing to do with monetary policy. It wasn't caused by Paul Volcker. Jimmy Carter put a cap on credit card interest and banks stopped issuing credit cards. So, well, that'll sink the economy. And then so Volcker reacted to that by lowering interest rates 7 percentage points, not 70 basis points, 7 percentage points, because we're in a recession, right? That's what Feds do, the Fed chairs do. But because it was a regulatory blunder, they fixed it and the economy came roaring back. And then inflation really took off, worse than when Volcker got in 79, early 1980. So Volcker had to take rates to 20% to get inflation under control the second time after cutting them in 1980. And that's called the Volcker mistake or the Volcker blunder. And Volcker himself, I spoke to him, he said that was a mistake, that I should have stuck to my program, not worried about the economy and unemployment, but just got inflation under control. But when he threw in the towel prematurely, the inflation went to the moon. Jay Powell doesn't want to be that guy. Jay Powell knows that episode as well as I do. And he doesn't want to be the guy who throws in the towel early and then inflation just goes to the moon. And then then he has to take interest rates to, 15% or something ridiculous. So Wall Street's saying, you're already there, mission accomplished. Powell's saying, not so fast. They told Volcker that, and he cut rates and it was an enormous mistake. So Powell's not going to be that guy. So what is the terminal rate? 2 weeks ago, it was 3 weeks ago, it was at 5.25. Today, I would say 5.5, because we had a lot of hot data, unemployment down, job creation up, retail sales up, not to the moon, but these are the opposite of what Powell is looking for. So he's had no confirmation that inflation is coming down on its own. He's had a lot of data that says inflation may be getting ready to take off again. So you got to say the terminal rate went from 5.25 to 5.5, maybe more. Let's see what he does in June. So that's and Powell always said, I don't care if there's a recession, I don't care if there's unemployment, because the long-term costs of inflation are going to be much greater than those short-term problems. We got to suffer through that to get a bigger problem under control. So you're exactly right about how he thinks of inflation. He said this many, many times. Now, along comes Silicon Valley Bank. Okay. Oh, by the way, in addition to raising rates, don't forget QT, quantitative tightening. They were shrinking their balance sheet.
Yep.
And it's very hard to estimate the monetary impact of shrinking the balance sheet, but the best estimate is for every $1 trillion you take it down, that's probably equal to a 1 percentage point hike in the Fed funds rate. So the tightening has been more than just taking the Fed funds rate up. You also have to take into account QT. Now let's go back to what we said about the bond guarantee and bailing out the entire banking system. And you said, gee, doesn't that mean that a lot of banks will be sending the bonds to the Fed and getting cash? Yeah, that's exactly what it means. You're right. What is that? Well, where's the cash come from? You got to print it. So on the one hand, we're doing quantitative tightening by letting bonds mature and not reinvesting. But on the other hand, you just send an open invitation, open party, house party to every bank in the country saying, send us your bonds and we'll give you cash. Not only that, but 100 cents on the dollar, even if they're worth 80. So you're going to have potentially trillions of dollars of new money being printed at a time when the Fed's trying to get inflation under control and they were trying to shrink the balance sheet. They're going to be expanding the balance sheet. So I mean, there's no way out. There's no good way out of this. You can have, pause. I don't think they will, but you could pause on March 22nd, not raise rates, right? And implicitly saying we're not going to raise rates for the foreseeable future because we got all these losses in the banks. Okay, inflation goes to the moon. I promise you, it'll just take off like a rocket. Or you can raise interest rates 25 basis points in March, maybe another 25 in May. There's another meeting in May. See about June. And we'll continue this war on inflation, but you're just going to increase the bond losses in the banks and make them send you more bonds and get more cash. So there's no, or the third thing is just take away the umbrella and let all these banks fail. I mean, those are your, it's like name your poison, you know, as like name your poison. You can have runaway inflation, severe acute banking crisis, or basically a lot more, as I say, a lot more bank failures, and a severe recession because you're going to keep raising rates. But there are three choices, but none of them are good.
Yeah, like you said at the beginning of this, they are backed into a corner.
Correct.
Do you on next week? Do you have like a probability? What do you think? Do you think they pause? Do you think they do 25 basis points? Like, do you have a best case? You know, the most, I guess, the highest probability in your view.
Yeah, 25 basis points, and I say that because they were 25.50, and I was keeping an open mind. We got to, you know, by the way, they always leak it. We'll know in advance. They always leak it. You just have to know who the leakee is. And you know, it's Nick Timiraos said the Wall Street Journal. They have a rotating list of journalists, but right now he's the guy, a really good reporter, but he's the guy that Jay Powell picks up the phone and says, Nick, here's what we're doing. There's somebody, maybe one of the other governors. But so let's see, it's March 15th, 7 days to go. They'll probably leak it in the next 2 or 3 days. So read Nick every day in the Wall Street Journal, and you'll know when I know, and we'll all know in advance because they leak it. This is the no drama Fed, except they got a drama anyway for other reasons. So we'll know. So the market was pricing about 5.4 for terminal rate, and they were pricing about 40 basis points for the rate hike. This is before Silicon Valley. Well, there won't be a 40 basis point rate hike. It'll either be 25 or 50, but the market was leaning to 50. That's clearly back down to 25. 50 is off the table. So the question is, will it be zero? And I would say no, because they've kind of shredded the credibility anyway with the deposit insurance. They have to maintain some credibility with regard to inflation. And the ECB will go first. That'll be actually a more interesting test to see if the ECB goes up 50, and I expect they will. So the central, and they talk to each other, of course. So the central banks are going to stay on course, ECB 50, Fed 25, and see what happens. But we kind of already know the more interest rates go up, the more those bond portfolios go down. They'll be, here's the Fed's bet. They're going to do the 25 basis points to fight inflation. It will cause the value of the bonds to go down, but since they've already guaranteed them by saying, you know, send us your bonds, that the market won't panic because there's a safety valve there. So they have, in the Fed's mind, they have the best of both worlds. They get to keep fighting inflation, but avoid panic, because they've already said in advance, we'll take all the bonds you got and give you 100 cents on the dollar. So what are they missing? They're missing the fact that it's not a closed economy. It's a global economy. And you brought up Credit Suisse, and you're exactly right. The Arabs have said, we're out, we're done. You know, well, good luck, but we're not giving them any more money. And the market is challenging them, challenging the Credit Suisse. And, you know, I kind of lived through this with long-term capital management. These panics have two stages. Stage one is like, everybody's nervous. You know, again, I'm getting unsolicited emails. Should I take my money out, take my 30 grand out of the S&L, whatever. Everybody's nervous. Everybody's looking around, who's next, et cetera. But then it's kind of like the marlin and the old man in the sea. You know, the sharks settle on one target, and they just they systematically trade against the target. And that's what, you know, in LTCM, we lost $1 billion in August, and we lost another $1 billion in September. But the difference was we had to report the August result because we report it monthly. So in August, we were part of a big global crisis. Russia defaulted, a lot going on. But in September, we became the marlin, and Wall Street systematically attacked us. And I'm not asking for sympathy. It's just how it goes. But that's happening now. The market will systematically attack Credit Suisse until they break it. This Credit Suisse is the marlin and the old man in the sea. Wall Street are the sharks, and it's systematic. So that means Credit Suisse well, it can't fail. It is too big to fail. I mean, that's still true. So the Swiss National Bank is going to have to bail them out. Now, here's where you're always back to the Fed, because it may be a Swiss bank, but I dare say their operations in the United States are bigger than their operations in Zurich. I dare say most of their liabilities are denominated in dollars because they're a big participant in the Eurodollar market. So the problem with the Swiss bank, they can print Swiss francs all day long, but they can't print dollars. Mm-hmm. So where does the Swiss National Bank get dollars to bail out Credit Suisse? The answer is they call up the Fed, and they have these swap lines. And the way it works, the Swiss National Bank sends the Fed a whole shipload of Swiss francs, and the Fed sends the Swiss National Bank dollars, and it's a swap, and it will be undone at some point. But these are central bank currency swaps, and then Swiss National Bank will hand out the dollars to Credit Suisse, but they'll take it over. So the Swiss National Bank will bail out the depositors, but they will not bail out the stockholders. So those people are going to take a beating, and they'll probably have to take over Credit Suisse. Now, can you sell it as a going concern, sort of, to who? UBS, JP Morgan, as if they're not big enough? I don't know the answer to that, but you'll either have to recapitalize it and just kind of relaunch it with a new IPO as the new Credit Suisse, keep everything the same, but wipe out the stockholders, wipe out some of the bondholders, protect the depositors, and relaunch the franchise with new capital coming from whatever, the government, or maybe Saudis will buy the new bank. And you can do that. Or we'll just go into liquidation. Hey, we're going to protect the depositors, but we're going to sell off the assets to, sell the asset management to BlackRock and sell the investment bank to Goldman. I don't know. And then eventually, pay themselves back and undo the swap with the Fed. I'm sure they've already thought of it. Everything we're talking about has already been considered. Since 2008, banks have been required to have what they call living wills. You're told by your regulator, if you were bankrupt tomorrow, going insolvent, what would you do? What's your plan? And give it to me. And then they critique it. It's done iteratively, but so Credit Suisse has a living will. The Swiss National Bank has it. Of course, the best laid plans, you never know until you try to implement these things if they actually work or not. But so there's a playbook and they're ready, but I don't see how Credit Suisse gets out of this, because it's not just, they got balance sheet problems, they have asset problems. This is, as I said earlier, the sharks are attacking the marlin, and there'll be nothing left except the head and the tail.
It's so interesting too to hear you bring up like your long-term capital management experience. It's so helpful for folks, and that was fascinating too, like the 2 stages. Let me ask you this, because just got me thinking too, like when you see like government intervention, whether it's like making sure all non-insured depositors in the case of like SVB are like basically fully back, you have access to all of your funds and whatnot, and you've seen a series of interventions on these various risks that have popped up time and time again. So it just makes me wonder, is there going to be a day where we are building up for like this ultimate reckoning, like a mother of all crises, if you will, just by all this intervention? What do you think? Is it, it's just a thought that kind of I'm thinking about.
I think that's a very likely scenario. And I did, it's a great point. I discussed this in my book, The Road to Ruin. That book came out in 2016, but it's, it's available on Amazon. But I discussed this specific scenario. And the point that I made is that at the time, it was post 2008 crisis. And I kind of came up with a 10-year tempo. I said, okay, 1998 was long-term capital management Russia. 2008 was the global financial crisis, Lehman. We all know that story. So I looked ahead to 2018. Turns out I was off by a year because the pandemic was in 2020. But but the idea was that, yeah, they have bailed out everything. Go back before 1998 to 1994. If you actually start in 1987, when the Dow Jones fell 22% in one day, not in a year, but in one day, then tequila crisis, long-term, .com, the global financial crisis, pandemic, and now Silicon Valley. Just take the gaps between all those, add them up, and divide by the 7 or 8 crises. And the tempo is like every 7 years or so, every 6, 7 years, these things happen. It's not like, Jeremy Diamond once said, it was so rare as once since the beginning of the universe, and one chance in like 3 billion or something, 3 trillion or something. I don't know. And I said, Jim, you must be having a really bad day. If the odds are that far against it, and that's what happened to you. This was when remember the London whale scandal. If the odds were that much against it and it happened to you, you must be really unlucky. The truth is, those are not the right odds. That's a normal degree distribution. That's not how financial crises go. It's really a fractal pattern, and it's a power law, which means that they happen with a lot more frequency. And the right tempo is 6, 7 years. So if you go back, 2020 was kind of a one-off. It really wasn't a financial panic. It was an economic collapse because of Fauci and the rest of them. But if you say 2008, okay, 14 years, 15 years, that's a long time between crises because the tempo had been shorter. So we probably shouldn't be too surprised this is happening. But my observation was, yes, the Fed has bailed them all out. Yes, they happen with greater frequency than the statisticians will tell you. In 7, 8 years on average, this one was a little bit longer. But each bailout is bigger than the one before. And that was the key. The LTCM Russia bailout was bigger than the tequila crisis. The global financial crisis was bigger than LTCM, and this one, they just bailed out $6 trillion of bank deposits and bond holdings. Each one's bigger than the one before. So the question is, does there come a time when the crisis is so great that it exceeds the ability of the central bankers to bail it out? It's like, okay, you played your last card, but now it's bigger, and even you, Mr. and Ms. Central Banker, don't have the resources to do this. And I think we're at that point. And I would add one more observation. A lot of it, printing money, QE, bond guarantees, reverse repo facilities, et cetera, it all works to some extent. But the key ingredient in all of it is confidence. It's like, it works partly because people believe it will work, and they're like, oh, you're the Fed, you're smarter than I am, you must know what you're doing. I know a lot of people at the Fed, they're not smarter than we are, or all of our listeners are. They just put on a very good front. But the front is based on confidence. And what's happening is the confidence is eroding. It's like, oh, you kind of, you lied to us about Ukraine, you lied to us about COVID, you lied to us about masks. 5 million Americans who were double vaxxed and boosted got Omicron in December 2021. So wait a second, you're double vaxxed and boosted and you got Omicron. There are 5 million or more, according to Johns Hopkins, just Americans. Don't tell me the vaccines work. Obviously, 5 million people got it. So the vaccines don't work. They do other things. It's a treatment and not a very good one at that. But we've been lied to about so many things. Now we're being lied to about Ukraine. We're being lied to about, Biden family corruption. And I don't know whether the policymakers are stupid or they think we're stupid, or maybe both, but they're wrong. The American people are at a point where they see through it. And so, and it got worse this last week. And Johnny Yellen says it's not a bailout. And I just explained that it was the biggest bailout in history by far. But the American people see that. You don't need PhD in economics is probably a handicap at this point, but you don't need that kind of training to see what just happened. And so people don't trust the government. I mean, it's not just my opinion. It shows up in polls like Rasmussen and other polls. That's very clear. So does the Fed try to pull a rabbit out of a hat? And everyone says, no, it's not really a rabbit, and you had it up your sleeve. And I see through your magician act, and it's phony. We may be at that point also. So I agree with you, or with the tenor of the question, which is that we may be at the point where we're beyond the capacity of the Fed or any central bank to do anything. And then you say, well, what next? Well, the answer is an extreme and coarse form of socialism, where you're like Argentina. where you actually are nationalizing everything.
Yeah. Do you, I know we have to run, but if you have a second for like just one more follow on.
Sure.
Okay. I'm trying to just think like, where do you see things? I kind of gather based on your answer where you see things headed. Do you see a time at some point in the future that you could get back to like more trust, confidence in institutions, less polarization, maybe less intervention? Do you see a time where that could possibly be in the future?
It's possible. We're pretty far gone, and then there's the question what physicists call phase transition. Do you actually do you go from water to steam? Does the water actually start to boil and then the pot's empty? Are we at that point where it's too late to do it in reverse? We maybe have to make allowance for that. We may not, although we're dangerously close. So what's the difference? Where, what could in effect save the country or overcome some of these issues that you're raising? And it always comes down to leadership. And right now, it's Republican and Democrat. I'm not picking sides on this. The leadership is unbelievably weak. Let's start at the micro level. Why was the UK risk manager of Silicon Valley Bank spending all her time promoting Pride Month and LGBTQ, I don't even know, plus whatever, awareness? Like, I'm not saying nobody should talk about that. I'm saying you're the risk manager of Silicon Valley Bank. Why weren't you looking at your maturity mismatch? Why weren't you looking at the volatility of the bonds? Why weren't you basically diversifying your portfolio? Why weren't you locking your deposits for longer periods of time? Why weren't you hedging with futures and options? You're putting out the pride flag. And again, do your thing with the flag, but don't tell me you're a risk manager of a bank. All the way up to the White House. And, I'm not going out on a limb. Biden is severely cognitively impaired. He did a little press conference, not actually, it wasn't a press conference because he didn't take questions. He made a statement on Silicon Valley Bank the other morning, and then he just walked off. If you want to see something scary and you see Biden on TV, hit the mute button. What the Germans call MOS, without sound. You just hit the mute button, and it's 10 times scarier than anything he said. I mean, he's frail, he's shuffling, he's had 2 aneurysms, he's severely impaired, but he couldn't get out of the room. The reporters are shouting questions. He couldn't get out of the room because he couldn't work the doorknob. I mean, just go to YouTube and find he couldn't get the doorknob straight. If I'm saying that, and I do say that, I have an intelligence community background, don't think the Chinese and Russian and Iranian and Turkish and Israeli intelligence services hadn't reached the same conclusion a long time ago. And what you do when you have people like that, you test them. And so my question is where, by the way, Henry Kissinger is 100. He's still writing books. So it's not about age per se. It is about capacity. And, Alzheimer's, that, I've studied this in a demographic context. Alzheimer's, dementia, cognitive decline, highly correlated with age. It doesn't mean, again, Kissinger is fine. He's 100, but Bernie Sanders seems very feisty and articulate at 82, I believe. It's not 100% correlation, but it's a high correlation, and it's a serious problem. So where's James Baker? Where's George Shultz? Now look at how the U.S. got the budget, the debt to GDP ratio under control after World War II. World War II, at the end of World War II, is the second highest in U.S. history. The highest is today at 130%. But that time is about 120%. But, at least we won the war. We were a global hegemon. But between 1945 and 1980, the debt to GDP ratio declined from 120% to 30%. 30% is fine. It's like owing $5 on your credit card. You're like, yeah, no problem. Everyone would agree 30% is a very comfortable level. Angela Merkel and the Europeans said 60% is our ceiling. Carmen Reinhart and Ken Rogoff, who have done some brilliant work on this, said, yeah, and 90% debt to GDP, that's where you go through the looking glass. That's, at a lower level, you borrow $1, you spend $1, and you get more than $1 of GDP. When you go over 90, you borrow $1, you spend $1, and you get less than $1 of GDP, which means if you look at the numerator and the denominator, your numerator is going up by $1, but your denominator is going up by less than $1, What does that do to the ratio? The ratio goes up. So you're trying to borrow your way out of a debt trap and you can't get there. And we're at 130%. By the way, that lunch table is, see who else is at that level? Lebanon, Greece, and Italy. So that's your lunch table in terms of, not exactly the
Yeah,
crowd you want to hang
not
out with.
exactly. Yeah, and
Uh,
I'm just looking at the U.S. national debt just ticking higher. I always go to like U.S. debt clock,
yeah,
31.6 trillion and ticking higher as we speak.
right. But that's right. But come back to the going from 120% to 30% between 1945 and 1980. How was that done? It was bipartisan. Harry Truman, you had Democrats like Harry Truman, John Kennedy, Lyndon Johnson, and Jimmy Carter. You had Republicans like Dwight Eisenhower, Richard Nixon, and Gerald Ford. So it was never Republican versus Democrat. It was just, here's what America does. We blow up the debt to win a war, and then we bring it back down again in times of peace. And it's like dry powder. And if we have to get into another war, we can blow it up again. And this, I trace this, my book, this is also in Road to Ruin. I took it back to George Washington and Alexander Hamilton. But so when did the debt blow up? Civil War, Mexican-American War, Spanish-American War, World War I, World War II, Vietnam, exactly when you would expect. And when did it come down? 1870s, no wars. 1950s, no wars. It was a Cold War, but not a shooting war. We've done this over and over through Republicans and Democrats. So, and where's James Baker? He was the convening power on the Plaza Accord and the Louvre Accord. This is like adult stuff where serious people get together with serious problem and they fix it. James Baker's still around, but he's 87, 88. Let the man enjoy retirement. But I don't see people of that caliber, the George Schultzes and others on the scene today. Janet Yellen knows nothing. I mean, she's got a high IQ, but she's a labor economist, statistics geek. She doesn't know anything about what we're talking about. She was, the day before Silicon Valley Bank, she was giving a speech on climate change. And she went to Ukraine and said, whatever it takes. How about California? How about the United States? So she's clueless. Again, I hate cliches, but it works. But I don't see that caliber of leadership. So if you said what could fix it, some really, really strong leadership. But you can be a Republican or a Democrat. But I'm talking about seriousness of purpose, not just high IQ points, but practical approaches, good rapport. That's what we need.
Yeah, and perhaps more civility as well. And like you referenced a lot of folks who worked in partnership with one another in the past.
Yeah.
Jim, do you have any parting thoughts for the audience? Anything that we didn't bring up that's top of mind for you, and also share where folks can subscribe to your newsletter or pick up your books? I'm going to give you a few minutes to do so.
Well, thank you, Julia. Yeah, the newsletter is Strategic Intelligence. My publisher is Paradigm Press. So that's an easy. Just Google Strategic Intelligence, Rickards Paradigm. It'll come up. We have a landing page, and all the publications are there, and you can shop, browse around and subscribe to one. But Strategic Intelligence is our flagship. We put out 6,000 or 7,000 words a month in a monthly issue. So you get 12 issues. I write 5,000 of them personally this month. No surprise, we're going to do Silicon Valley Bank. So that's why if I seem to be immersed in it, I am. My books are all national bestsellers, several New York Times bestsellers, which is kind of the gold standard. They're all on Amazon. Just Google Jim Rickards on Amazon. They'll all come up. And it's funny. My first book in 2011, it's a little bit of a cult classic. It still sells well. There's Currency Wars, but Currency Wars never went away. And I said that in the book. There's a long section in that book, again, 2011, on Russia, Ukraine, and natural gas. So I kind of nailed that, 12 years ago, but it's the cause of a war right now. But yeah, thank you. And then very active on Twitter at James G. Rickards, Rickards. I use my middle initial, so at James G. Rickards. I have an open account, so you don't even have to join Twitter. You can just type that in and read to your heart's content. But other top of mind is the one that's always top of mind, Julia, which is gold. Because I'm getting a lot of inquiries like, hey, I'm getting my money out of the banks, or I don't trust the banks, or the U.S. Treasury, they're playing games. What can I do? And I said, well, in terms of the system, There's nothing you can do. This is a lesson that was taught to me. I was a 27-year-old starting out banker at Citibank back in the day. But Walter Wriston was the chairman, and Walter Wriston was the CEO. He was the second greatest banker of the 20th century. So number one, I'd give to Pierpont Morgan, but I would give Wriston number two. And but he was very open, and I was a senior officer. I got to hang out, and I had a conversation with him once. I just seen this movie Rollover with great Jane Fonda, Chris Christopherson, Hume Cronin in 1980. But it was about what we're talking about. It was like a Silicon Valley Bank situation that spun out of control and the financial system collapsed and all that. But it started with the Arabs taking their deposits out and buying gold. And that was kind of happening. And it's what was going on with Silicon Valley. So I said, I was CEO. I said, Mr. Wriston, I said, what's to stop the Arabs from taking all their money out of Citibank and buying gold? And he said, nothing. He said, but somebody sold them the gold and they got the money and they put it back in the bank. And it could be a different bank, but they lend it to us in the Eurodollar market. In other words, it's a closed circuit. The money doesn't go anywhere. And that was like, that kind of hit me right between the eyes. It's like, actually, you're right. An individual can get the gold, but you're paying somebody else the money. They're putting it back in the bank. And at the end of the day, the money never escapes the system. It is a closed circuit. So the key ingredient is the interbank market, banks lending to each other, except now we have the Fed lending to all the banks. But that doesn't stop an individual from taking her money out and buying gold. And, I'd never do anything 100%. I've always recommended a 10% allocation, season to taste. If you want 5%, fine. If you want 20, it's on you. But I think 10% is the right amount. And it's not bank money, and physical. Take physical custody, put it in a safe place, like private vault. Don't put it in the banks because that's the first place the government will go. It's all legal, by the way, but it's your money. But it's not digital, and so you can't freeze it, you can't hack it, you can't, steal it. It's just gold, and so I think it has a place in every portfolio.
And you avoid like you don't have that counterparty risk as well when you have gold. Is that correct?
Correct. That's right. That's exactly right.
Well, Jim Rickards, really enjoyed having you on. I appreciate you taking the time, and I always learn from you. So I'm grateful that you took the time. Thank you so much, Jim Rickards.
Thank you, Julia.
Hey, everyone. I really hope you enjoyed that video. Be sure to hit that like button, the subscribe, and that bell so you won't miss any new videos.